Hi guys, thank you so much for joining me in another video. Today I want to talk about my 5 tips for stock market investing. I've had a few comments in recent weeks about investing in general, and the majority of times I'm being asked questions related to the stock market, and so I wanted to share my 5 tips, and actually very close to what I do when investing in the market. Remember, as with all types of investing, you shouldn't listen to a random woman on the internet. Do your own research and invest according to your own personal circumstances. Just gotta put that disclaimer out there, right? That being said, here are 5 tips, or how I like to refer to them, 5 nuggets of information for you guys to think about. The first one is, and I'm going to do a little bit of a Boris here, is when you buy matters, except it doesn't really. What I mean by that generally is that the market is cyclical. It goes up a while, then drops considerably, and then recovers and continues going up. These are semi-decade to decade trends, and an economic cycle like this has historically lasted about something like, 58.4 months since 1945, and our current one until the corona correction was about 10 years. So economists generally tend to believe that cycles will be longer now, but what on earth do they know, right? The message here is patience. So what goes up will come down eventually, and what goes down will recover. So we're talking about economies in general. So the underlying message here is that when there is a correction, treat it like a massive sale. The worst time to buy is when news reports are talking about all-time highs, and the best time to buy is when everyone is scared and losing their minds around the world and worried we'll be overrun by zombies, you know, all of that jazz. So when a sale is on, take the opportunity to buy quality companies on the cheap. So Apple at the virus bottom has practically doubled, and McDonald's since the virus bottom has gained 54%. So the key is be patient. The second tip I'm going to talk about is invest, don't trade. Now bear with me while I have a little rant here, because there are a myriad of trader videos you have on YouTube of hotshot traders with their Lambos, penthouses, selling you the secrets to trading Bitcoin to become millionaires. All of that is bollocks actually, excuse me. There's no magic system and there's no trading secrets. There are traders who make money. That's not a myth, but they work hard, disciplined hours. They're programmed a certain way, and even then they make very good salaries rather than the millions that people think that they do. Can it be taught? Perhaps, but you won't become an accountant overnight. So I don't understand why people or fools on the internet think that they can become traders overnight. Okay, anyway, ran over. So investing is not trading. So find quality companies, hold them for the long term, and there's a really good book called Quality Investing by Lawrence Cunningham. I'll link it down there below, which looks at one of the best hedge funds in the world and how they buy quality companies and hold them for the long term. So if you are buying stocks, do the same. Find quality and hold for the long term. Companies take time to grow, and eventually they deliver returns to the shareholders. Personally, I only rebalance my portfolio once a year, and then take the entire year to research my portfolio and decide what I'll do every November. If you guys are interested in seeing me do that, then drop me a note below and I'll try ramping up a video towards me picking my selections back in November. But that's my Christmas shopping, if you like. The third tip I want to talk about is drip feeding your investing. So I've mentioned in previous videos where you should try and save as much money as you can and then invest as much as you can, and do that consistently. As you can see in my compounding video, which I'll link down there below, it's quite a good one, on the impact that that will actually have in the long term. So I guess the moral is, don't put all your chips on one color. No one can predict the market, and you'll feel awful if you buy at the top of the market only to find news that there's a new virus that's brought catastrophe to the market. So instead, what I personally do is, with each income cycle, I budget for the month what I need, and then I allocate the rest to my investment accounts and deploy into my various strategies that I have running. So I drip feed into the market trackers each month into tax efficient accounts. Put money aside for my annual Christmas shopping for stocks. So if you have got a set amount to invest each month, the key is to dollar cost average your way in, which is basically putting in a set amount or when a price point is reached. For me personally, I prefer the set time thing, as then I don't need to decide or think about whether the market is cheap or expensive. I just know that over the next 20 years I'll be okay because of historical returns. Right, so the fourth tip that I want to talk about is income versus growth, right? So now I might be oversimplifying this here, as there are a myriad of investing strategies out there and lots of videos if you want to go into more detail. Personally, I prefer income, growth and contrarian strategies myself. However, when investing in the markets, we tend to invest for growth. Another very popular strategy is to invest for dividends. Now, I've got a few videos on dividends already, so we'll link them in the description, including a nifty checklist that I put together when picking robust dividend stocks. Go check it out if you are thinking about dividend investing, because I do go into a lot more detail on the rules that I put together for picking my dividends. However, the point here is that buying dividend stocks themselves provide an income stream, and that's a fact. Most of them do this quite regularly on a quarterly basis. This strategy is hugely popular for the FIRE community and all you FIRE seekers out there, as it creates a recurring income stream, and that can dramatically reduce the money you need invested in order to retire. Similarly, while we are all building dividend pots out there, we can use something called DRIP. And this is the process where you compound your returns by essentially reinvesting your dividends. So all the while where you're not spending your dividends, if you reinvest them, that grows your pot more. And that is called drip feeding your investment. The fifth and final tip I'm going to put out there is greed. Guys, we all agree green is green. Profit is profit. If you have a plan in place, don't hold on thinking it will go higher. Take the profit and move on. And that's one of the rules that I have in my selections. Don't look back. So there's William O'Neill in his book on how to make money in stocks, gave the turkey example. Originally, the story was told by Fred Kelly, the author of Why You Win and Why You Lose. I'll put the links down there below if you guys are interested. And I thought about recounting the story to you guys, but then I thought, hell, why not? Why not just read it directly? It's told so well already, and I'll never do it justice, right? So here it is. I'm gonna grab my book by William O'Neill on investing and why you should cash in. Let me just grab that book. Right, so I did put the page in, page 91. So here goes the turkey story. That's the book, guys. A little boy was walking down the road when he came upon an old man trying to catch wild turkeys. The man had a turkey trap, a crude device consisting of a big box with the door hinged at the top. This door was kept open by a prop to which was tied a piece of twine leading back 100 feet or more to the operator. A thin trail of corn scattered along a path lured turkeys to the box. Once inside, the turkeys found an even more plentiful supply of corn. When enough turkeys had wandered inside the box, the old man would jerk away the prop and let the door fall shut. Having once shut the door, he couldn't open it again without going up to the box, and this would scare away the turkeys that were lurking outside. The perfect time to pull away the prop was when as many turkeys were inside as one could reasonably expect. One day he had a dozen turkeys in his box. Then one sauntered out, leaving 11. "Gosh, I wish I had pulled the string when all 12 were in there," said the old man. "I'll wait a minute and maybe the other one will go back in." While he waited for the 12th turkey to return, 2 more walked out on him. "I should have been satisfied with 11, the trapper said. "Just as soon as I get one more back, I'll pull the string." 3 more walked out, and still the man waited. Having once had 12 turkeys, he disliked going home with less than 8. He couldn't give up the idea that some of the original turkeys would return. When finally 1 turkey was left in the trap, he said, "I'll wait until he walks out or another goes in, and then I'll quit." The solitary turkey went to join the others, and the man returned empty-handed. The psychology of the normal investor is not much different. They hope more turkeys will return to the box when they should fear that all will walk out and they'll be left with nothing. Remember, this is an interesting story of how an investor thinks about timing when contemplating a selling decision. So there you have it. Let me know your thoughts down there in the comments below. Until next time, make sure you like, comment, subscribe if you haven't already. What are you up to? But yeah, cheers guys, bye.